Hi, I'm Sarah Kyle, and I'm joined today by Mike Mills. We are part of the legacy team here at Equity Concepts, and we wanted to just kind of check in. It's been a quarter into the year so far, and see what we're seeing in markets. We've hit some all-time highs so far, which sounds really great. But we wanted to look at what's going on under the hood and kind of what you're seeing for the year to come.
Yeah, great question, Sarah, and thank you very much. It's been a really good start to the year. I think it's important to give some context, though, to where we've been in the last 18 months or so. If you look back, 2023 was really dominated by AI and technology. Companies really driving the performance of the S&P 500. You've all probably heard the term the Magnificent Seven. We've heard it so much, we're probably tired of hearing it, quite frankly. But that's been what's it been in focus, if you will. And all of that kind of has a backing of AI in the marketplace. Their earnings truly were magnificent, so hence the Magnificent Seven. But now in 2024, we're starting to see the other 493 companies at S&P 500 step up with solid earnings. Valuations, though, overall are still high across the board, particularly, though, in the AI and tech-related companies of the market. So we favor really up in quality companies with high free cash flow in our portfolios as opposed to just high momentum growth and just the Magnificent Seven companies.
Yeah, and you mentioned free cash flow. Free cash flow is any cash flow in excess of expenses. So we like that as a metric for companies because it shows their success even outside of just revenue coming in. But to your point about valuations, though, Mike, with valuations being so high, is it still a good time to buy? It's a little concerning buying while the market is high because we tend to like to buy when it's down so we can pick up on that growth.
Right. Yeah, good question. And one that we get quite a bit, quite frankly. I mean, all-time highs are not the end of the market. You have to make an all-time high to make another all-time high, quite frankly. So the market's made, really been off to a good start this year, and it continues to make these all-time highs. In 2021, the market experienced 70 all-time highs, and then it took 2 years off before it made another all-time high in 2023. As of March 13th of 2024, it had already made 17 all-time highs this year. So we believe it makes sense to remain allocated to the market, particularly if you're a long-term investor, which most of us are long-term investors, and that dollar cost averaging in over the market is really the prudent approach. All-time highs aside, even though the S&P 500 had a very good year last year, up over 26% in 2023, I remind you in 2022 it was down 18.2. So if you put those two together, you're actually not break even. So it's below break even in the market. So after reading, listening to, and talking with many of the analysts out there, we believe the types of returns we've seen over the last 5 years may not be what you see in the next few years. We actually are thinking mid to high single digits, which quite frankly puts you back in line with historical norms in the market. We've seen volatility continue since the fall of 2023, and we think that's a good slide from JP Morgan that they put out, which shows average intra-year declines. And one of the things, and we'll leave this up for a while because I think it's good to really study this, is that the average intra-year decline is about a little over 14% negative for the year. Last year we hit 10%. That was in the fall of the year. This year so far, we really haven't had anything near that. So I wouldn't rule out one this year. It's historically normal to get those kind of pullbacks in the marketplace. So that doesn't scare us, doesn't shock us away from the market. What it does, though, really kind of solidify is that prudent approach of dollar cost averaging and being in a long-term investor.
So, Mike, what about geopolitical risks? We still have war in Ukraine and Russia. There's conflict now in Israel with this war in Gaza. How do the markets seem to be responding to these conflicts, and what do you see happening there?
Yeah, great question, Sarah. And we'll refer to a slide here in a few moments from our friends at JP Morgan, but it definitely seems like the market has really priced to perfection. And what I mean by that is that if you think about that from a perspective of history, a lot of times geopolitical events would drastically disrupt the market. In this chart, and I have it in front of me here, but we'll put it up on the screen for you as well, it's called Markets Around Geopolitical Events. In the past, events like the oil embargo, Iranian hostage crisis, things like that, actually lasted a duration in the market of 20, 30, 40 days of decline in the market. And what we've seen is the recovery time and also the duration of those turndowns in the market have actually shortened over time. This goes all the way up to 2022 when you saw the Russian invasion of Ukraine. The pandemic's not on here because it's not a geopolitical event, if you will. But I would say that the market is priced into perfection, meaning that any major geopolitical event that occurs could actually disrupt the market. So we'd be very cautious of that, but at the same time, we'd also emphasize that it seems like the market's been shrugging off a lot of these geopolitical events, when in essence, they probably shouldn't, but it has been.
So, Mike, let's shift gears a little bit, talk about cash and rate movements. That's been really the hot topic over the past couple of years. The market had originally priced in 6 rate cuts for this year, but the Fed's now reduced that more to the 2 or 3 range. How do you see that impacting our investments, and how much longer is it even a good idea to hold cash?
Yeah. There's a lot of cash being held out there. There's about 8 trillion sitting in cash right now across U.S. households and institutions. And last year actually was the best year for cash in 15 years. Hard to believe. But it still underperformed most asset classes last year. It's not been a bad place to hold some cash and some dry powder, if you will, between money markets and CDs that are yielding in the 5.25 to 5.5 range as well. But we've seen those start to come down. Over time, though, holding long term in those positions will have significant opportunity costs on that cash because we do believe inflation will probably stay higher than we're used to for some time, and rates will probably stay a little bit higher as well. But we've started to see CD rates beginning to come down since the beginning of the year, and you'll start to see money market rates come down as well. As soon as the Fed actually makes the first rate cut, that's when the rates on money markets will start to come down. We don't think that all this cash on the sidelines will immediately move into equities, but some will certainly move into bonds to capture higher yields. You mentioned the original thought about 6 rate cuts this year, and it was interesting because we thought that was a very aggressive posture by the market to say that we're going to price in 6 rate cuts. I don't think the dot plot actually ever had 6 rate cuts for this year. Right now, the dot plot's somewhere between 2 and 3 rate cuts this year, and we expect that'll probably be the situation, but probably not until the second half of this year. There's also been some outlier thoughts that the Fed could raise rates one more time. I think that's less and less likely. However, as all of us are experiencing at restaurants and grocery stores and the gas pump as well, inflation is still high in a few key pocket areas as well. And that could be the catalyst for the Fed saying, all right, we're not going to cut rates until a little longer or a little later, or we may raise rates one more time. I think that's less likely, but I put it out there because it's an idea that's floating around.
Yeah. So, what are we doing in our portfolios then to take advantage of, you mentioned bonds before, as these rates change?
Yeah, good question. So I mentioned earlier our favor for quality and free cash flow in our equity exposure. On the fixed income side, while we still have some cash sitting in money markets and CDs, we've started to lighten that up and started to pivot a little bit towards, I would call it the next duration level, if you will, of fixed income. It sounds kind of odd, but we're moving from 3 to 6 months in duration to maybe 2, 3, maybe 4 on the duration. So not a huge movement there, but you're certainly getting rewarded in the yield. And as soon as the Fed starts to cut rates and the bond prices start to appreciate, you have the yield that you've locked in, but you also have the appreciation of the bond as well. So it's kind of a win-win, if you will, to a degree. If the rate starts cutting, or if the rates start being cut this year and the Fed starts to move at that as well. The last thing I will touch on is really private asset classes. We haven't touched on that a lot this time, but I would say that things like private equity, private debt, private real estate, those asset classes that we have in a lot of our portfolios are areas that have actually hedged and done very, very well in this market environment. Now, you're not going to see them shoot through the roof in a massive bull market like you saw last year, which, by the way, was led by 7 stocks. But in a 2022 environment, all 3 of those asset classes did exceptionally well. Private equity and private real estate are really going to do well once you start to see the Fed cut rates. And in the months and years ahead, we believe you'll be highly rewarded for having those asset classes in the portfolio. Not to mention the lower correlation to the public markets with the volatility that we think we'll continue to see there as well. I want to leave you with a few reminders, though, before we kind of wrap up today. And that's, first, we talked about rate cuts. And I mentioned this earlier, but we do believe that we're higher for longer in rates and inflation. Higher for longer than most of us have been used to over the last few decades, quite frankly, which is not a bad thing. If rates start to come down and hover in that 3 to 4 range, that's not bad. If inflation is 3 to 4, that's also not too bad. But we need to get everything kind of down in that area, not certain pockets like food inflation that's so much higher and energy that's so much higher right now. For most of our clients, though, we're investing for the long term. And we believe that time in the market, not timing the market, is a very good policy. So we don't try to time the market in any way, shape, or form. I'd also add that while investing is a component of planning, if you do not have a goal and a plan, then where and how you're invested really is much less impactful. So spend the time with us, please, to sit down and let's work on your goals and your planning. We covered a lot in a short time today. As always, if you have particular questions about our investments, the market, or planning in general, please don't hesitate to reach out to any of us on the Legacy team. And on behalf of all of our Legacy team as well, thank you for your friendship and thank you for your trust. Have a great day.